welcome back. You're watching The Money Show on ET Now, and it's time for our Meet Your Fund Manager segment. Today, we are going to be bringing on board the fund manager of, two funds, the Nippon India Large Cap Fund and a fund that's been the hot topic for all of 2020, that's the Nippon India Pharma Fund. Pharma as a theme itself has been a very exciting one. But if you've been a regular viewer of The Money Show, and we've discussed this topic of thematic funds quite often, you will hear most of our personal finance experts saying that, look, it's perhaps best if you avoid a thematic fund, because then in that case, timing the fund becomes very, very important. And when you are investing in mutual funds, that's the whole headache you want to get out of. And that's keeping track of markets, keeping track of news and timing, so on and so forth. So let's now talk to the fund manager of one such fund itself to understand how exactly should one go about investing in these so-called hot topic funds. Let's bring on board Sailesh Raj Bhan, the Deputy CIO with Nippon India Mutual Fund. Mr. Bhan, thank you for joining us today on ET Now. So it's not just the Pharma Fund. I want to also talk to you about the Nippon India Large Cap Fund. Why don't you start off by telling us a bit about the Nippon India Large Cap Fund? Is all of the money invested only in the large cap or the blue chips?
Nippon Large Cap Fund's primary focus is on sustainable businesses which are available at reasonable prices. That's the kind of framework we use. By definition, being large cap, about 80 to 82% is invested in large cap companies. And the balance is invested in companies which have large cap characteristics but are today in a mid cap market capitalization range. And primarily, underlying thing is sustainable businesses, and we value growth at reasonable price approach when you choose to invest. So we don't buy growth at any prices. We don't throw away valuations. Valuations are an important factor in terms of evaluating the kind of portfolios we create. Broadly, the portfolio construct is today reflective of, it has an earnings profile of the portfolio having much better than what the index earning profile is. And the valuations of this portfolio would be about 10 to 15% cheaper than where the average index valuations are today.
Okay, Mr. Bhan, let's talk about now the Nippon Pharma Fund. It's more than a 50% rally that we've witnessed in this fund, in the year 2020. What's your view here? I mean, how do you go about firstly investing or picking stocks in the Nippon Pharma Fund? If you could just sort of introduce that fund for our viewers.
Nippon Pharma Fund has just completed 16 years. So over the cycle, we have played different subsegments of the pharmaceutical market. Like you rightly said, unlike a sector with a single characteristic, say unlike a cement or auto sector, in pharmaceuticals, you have got many subsegments which are very interesting and differentiated. One is the domestic market itself, the domestic big consumer market, which is there where you have the market growing at double digit for a long period of time, and you've got branded players which are very, very good. They are generally consumer characteristic businesses, and they just compound over a period of time. That is a very important part of our portfolio. Close to 50 to 60% of our investments are in those areas. Another 10% are in domestic healthcare, hospitals and diagnostic spaces. And the remaining 30 to 40% is invested in international opportunities, contract research and manufacturing, export areas, and also invested in, say, the US generic market space, where a lot of Indian companies are wanting to do well. Within the various subsegments, our preference is towards companies who have an ability to invest in R&D and companies who have great, presence in the chronic space in India, especially. So greater presence in the chronic space in India and a large enhanced ability to invest in R&D for the international markets. So most of our distribution is in large cap companies with maybe 70-80% invested in large cap space, primarily because the kind of portfolios these companies have created, their dependency on one or two products is very limited, and the sustainability of these businesses is way higher.
Okay. Mr. Bhan, the Nippon Large Cap Fund, if we just have to sort of check out the risk factor versus, say, a Nippon mid cap or a small cap fund. Though, mind you, again, people are looking at small and mid cap funds because, again, everyone's saying that, okay, it's going to be the broader markets that will outperform very well. But yeah, if we have to take a look at the risk factor, between a large cap fund versus a mid and small cap fund, how would you sort of pit these two categories of funds against each other when it comes to the risk factor?
Large caps traditionally have lesser volatility than the mid and small cap space. Like you would have seen in 2017, we had a fantastic run for mid and small cap businesses, but 2018 and 19 was a complete collapse for the mid and small cap space. So large cap characteristics are generally different from how the mid and small cap spaces behave, and hence the volatility and the variability is much lesser in the large cap space.
Okay. Now, the one factor that we've been noticing is that, post-COVID, there's been this very unsettling feeling, among a lot of people, especially since we've seen a fund house really have problems when it comes to, honoring redemption requests from investors. So, how do you essentially, what is your stock screening or filtering process, or how would you assuage investors with respect to the same?
Clearly, the developments post-COVID have led to a significant contraction in GDP for the first quarter, especially more specifically the first 2 months of the quarter. And this was adequately reflected in the prices, because prices also fell 30% or 35% in that period. If you remember the sharp fall in the month of March, which the market saw. So I think at all points of time, the market is trying to look what's going to happen in the next 12 months, 18 months, 24 months. And only in extreme conditions like COVID and all that, market just focuses on those 1 or 2 months into play. A typical, when all of us value businesses, right, the near-term valuation or near-term cash flows of the businesses account for maybe 10% of the value or 15% of the value. But a large part is actually in the future cash flows which a business generates. So from our point of view, I think if we have very sharp corrections because of events, whether it is COVID or whether you had challenges earlier with China's related slowdown or any larger events, I think these actually create opportunities for owning equities, because unlike other asset classes, equities get repriced on the downside also very quickly. So we see these as longer term assets, and the value creation takes place over a period of time. And if you have distortion in pricing because of these larger events, these are actually opportunities to keep on adding to or participating in. The best way to handle the volatility and the challenge for investors is to see that if their allocation has gone awry, if they're over allocated to equities than they would wish to be, and correct them accordingly, when valuations go on either side of the trade. So we see these events, which are either near-term events relating to COVID or any other challenge, actually reprices equities way faster because of the global linkages which exist. And that actually creates opportunities than distress for people. So if you're not leveraged and if you're able to use these opportunities in your side, actually your ability to enhance equity returns is way higher. And we have seen a lot of retail investors top up their SIPs or continue having SIPs even in these difficult times. And I think all of them would have benefited from the sharp declines which came in March, April, and May. And on an overall basis could enhance their longer term returns of investment.
All right, Mr. Bhan, I want to, once again speak on the Pharma fund. It works well for people, who don't want to, who want to bet on Pharma, pardon me, because it's obvious, right? We're in the midst of a health crisis, so it would make sense that Pharma would be a space that would rally, and it is. However, Pharma does have a lot of nuances. It has a lot of jargon, so it could, make people a little confused as to how to pick stocks. So the fund works well. However, what's your overall view on the Pharma fund? Do you think that from here as well it could still rally for the long term, for the short term? What's your view?
You rightly said the Pharma has seen a meaningful rally in the last 4-5 months. But if you look at directionally, prior to that, about 3 to 4 years are very difficult for the sector. So even after this rally, a lot of large size businesses in Pharma have valuations which are considerably cheaper than consumer businesses. And their earning growth profile is comparable or growing. So directionally, the sector is, yes, it is not as cheap as it was 3-4 months before, but it's certainly not in a zone of disproportionately being overpriced, especially in select categories and stocks. Secondly, from an opportunity space for Pharma, if you look at it, India is known as a very, very young country with a large number of people below the age of 25, 50% of India below the age of 25 or 28. If you look at it, India is also has a population of 27 crore people over the age of 50. And this is the real pharma consuming population, actually, because anybody over the age of 50 actually consumes multiples of medicines which anybody under the age of 50 would consume. So per capita consumption on 50 plus population is way higher. And this is a large and growing market. And, number of people in this particular age bracket over 50 years will actually keep on expanding every year for the next 15, 20 years in India. And it could well be a 45, 50 crore population base. So this is a very large market. And this is a market which requires solutions. As per capita incomes rise, insurance rises, awareness rises, and COVID has actually brought about much better awareness in terms of people's keenness to manage health, because they know that if you have challenges associated with health, any such development like this can be pretty severe. So I think we've seen that one domestic opportunity of a large base of 27 crore people who are over the age of 50, which is a large market which will just compound every year for the next several years, is a big space to be in. The second interesting space is being the factory to the world, or the pharmacy to the world. The pharma is possibly the only sector in India who sells its products in over 150 countries in the world, and has brands in over 20 countries in the world. So I think globally, if there is any sector which has demonstrated the Make in India capability, it is this sector. And I think that advantage is here to stay. And I think that sustainable advantage allows us to possibly grow further in very large global markets. So these two are very significant opportunities for investors to play in, and this sector continues to have the attractiveness. Is it as attractive as it was 3-4 months back before the rally? No, certainly not. But I think, can it at least compound in line with the earnings, which can double in a 4-5 year period? I think that possibility for the sector certainly exists.
So if that's the case, Mr. Bhan, and we always say that investing in a thematic fund can be very tricky because it's about timing, like you yourself mentioned, right? That, okay, maybe it's not as attractive as it was 3-4 months ago, but yes, it still is attractive. So it's all about timing, right? I mean, I wish I would have bought some pharma stocks maybe 3-4 months ago. So how should one invest in thematic funds?
The challenge of timing in a thematic fund is even more severe. It's very difficult. It appears easy on hindsight because everybody knows that sector has moved well. People think they can invest in March or February and exactly pinpoint and get the hockey stick in that particular sector. It's absolutely unlikely to capture. The only way to capture is when the sector is going through difficult times, any sector for that matter. Today there are many sectors also which are going through difficult times. Those sectors can be chosen today, and a SIP route in those sectors should be started. So typically choosing an SIP route in a thematic sector and having money at least for a 5-year kind of an horizon is a very good way to approach thematic or sector bets. Timing and getting the timing right is very difficult. I remember people were looking at this sector wanting to invest about even 6 months back, but they were saying that the sector is not doing well. Why should we invest now? And 6 months later, when the market has run up so much, or the sector has run up so much, the point of discussion is the sector has already done so much. Why should we invest now? So I think using an SIP approach is a very, very appropriate approach, in our opinion, to capture sector and thematic returns.